This presentation examines how receivables management influences a company's cash position and overall financial health. Accounts receivable is more than an accounting balance. It represents revenue that has been earned but may not yet be available for use. The key connection is between collecting customer payments efficiently and maintaining liquidity. We'll focus on why receivables matter for cash management, how they affect planning and decision-making, and why strong control in this area is essential to a sustainable business plan. Accounts receivable represents revenue the business has already earned but has not yet collected. In a business plan, it's more than an accounting entry. It's a direct cash flow lever. The key issue is timing. Uncollected revenue ties up working capital that could otherwise support payroll, inventory, or daily operations. Even when sales look strong, slow collections can create financial pressure. That's why investors pay close attention to the quality of AR. It can reveal how reliably the business converts reported sales into usable cash. Accounts receivable, or AR, represents amounts customers owe for goods or services they've already received when payment was made on credit. It is recorded as a current asset because a business generally expects to collect that money within 30 to 90 days. Revenue does not equal cash. A sale can be recognized today, while the related cash arrives later. That timing gap between making the sale and collecting payment is essential for understanding cash flow and managing the company's short-term financial position. The cash conversion cycle follows a journey from making a sale to having cash available to spend. A business first sells on credit, then invoices a customer, and finally waits for payment. The time between that initial sale and collected cash is the cash conversion cycle, or CCC. A shorter cycle means money returns to the business faster, improving liquidity and making it easier to cover expenses, invest in operations, and reduce reliance on external financing. That makes CCC reduction an important part of cash management. This slide highlights 3 complementary ways I evaluate receivables performance. Days Sales Outstanding, or DSO, estimates how many days it takes to collect after a credit sale, so a lower number is generally better. The AR turnover ratio shows how frequently receivables are collected during a period, with a higher ratio indicating more efficient collection activity. Finally, the Collection Effectiveness Index, or CEI, compares actual collections with the collectible receivables available. A result close to 100% suggests the organization is collecting nearly all it realistically can. An accounts receivable aging schedule groups unpaid invoices by how long they've been outstanding. It gives us a practical way to assess collection risk and decide where follow-up is most urgent. Invoices up to 30 days are generally current and low risk, while those at 31 to 60 days should be monitored closely. Invoices outstanding more than 60 days require immediate attention, with 90-plus days representing a high default risk and potentially a need for write-off. Including this analysis in a business plan demonstrates creditor awareness and disciplined collection practices. Not every invoice will be paid, so a realistic business plan needs to account for potentially uncollectible receivables. The Allowance for Doubtful Accounts, or ADA, estimates a portion of accounts receivable that may become bad debt. Its purpose is to reduce gross accounts receivable to net realizable value, which is a more realistic view of expected cash collection. Businesses typically express the allowance as a percentage of total receivables or credit sales. Industry averages commonly range from 1 to 5% of accounts receivable, helping lenders and investors evaluate projected cash inflows. Credit policy forms a foundation of healthy receivables by balancing sales opportunities with payment risk. Clear credit terms set expectations from the start, whether that means net 30 or an early payment discount, such as 2/10 net 30. These incentives can accelerate cash inflows and reduce days sales outstanding. Before extending credit, I also need to assess customer creditworthiness using scores, trade references, and financial statements. Finally, credit limits cap exposure for each customer, helping ensure one account cannot destabilize overall cash flow. To accelerate collections, the focus is on reducing the time between delivery and cash receipt. First, invoice immediately because any billing delay pushes payment further out. Next, consider a 1 to 2% discount for customers who pay within 10 days, when a faster cash conversion justifies the incentive. Automated reminders can keep invoices visible before and after the due date without adding manual work. Finally, when collections are lagging and immediate liquidity matters, Receivables Factoring provides cash by selling outstanding invoices to a third party at a discount. Accounts receivable is more than a balance sheet line. It connects the entire financial story in your business plan. AR analysis must align across all three core statements. Revenue appears on the income statement when a sale is made, not when cash is collected. On the balance sheet, receivables are reduced by the allowance to show their realistic asset value. And on the cash flow statement, changes in AR directly affect operating cash flow. Investors also study AR trends to judge whether your revenue projections are truly realistic. The key message is simple. Revenue does not equal cash. Track collections alongside bookings and monitor receivables continuously using DSO, turnover, aging, and CEI. Finally, build these practices into the business plan through AR projections, bad debt allowances, and a clear credit policy that demonstrates financial discipline.